Hey everybody, welcome to Midas Letter Daily for this Monday, February 14th. Happy Valentine's Day. Today I'm going to be speaking to Francis Létourneau, CEO of NuRAN Wireless. Full disclosure, he's one of our clients, as well as Mark Beveridge, Principal Consultant with Benchmark Minerals Intelligence. If you don't know Benchmark, they are the price information and tracking company out of the UK that follows battery metals very closely. So today I want to start off with a look at lithium prices. Lithium prices have continued their upward trajectory, with COMEX Lithium Futures notching 5.45% higher by midday today. Also, PayPal announced that its buyer protection program, covering users of its platform for up to $10,000 against fraud or loss, would not be extended to include NFTs or non-fungible tokens. Presumably, that's in response to the growing number of Rugpulls, where NFT founders essentially disappear into the night with the funds raised from buyers for these virtual graphic creations. The most stunning example recently is back in January, Doodle Dragons, which was an NFT verified by the Solana crypto group, who, after raising an undisclosed sum, but was likely in the hundreds of thousands of dollars worth of Ethereum, announced on its Twitter account that their new charity would be, and I quote, "my bank account," and signed off with "see ya nerds" before deleting the account. If you're wondering about the prevalence of fraud in the NFT space, just Google NFT frauds and you'll see why PayPal took the step they did toward eliminating NFTs from its platform. Last week, the United States Federal Reserve published the scenarios and assumptions under which it would stress test 34 large banks for their ability to endure a financial crisis in 2022 that might extend for up to 2 years and still be able to continue operations lending to mainstream America. Stressing that these were scenarios and not forecasts, the Fed was going to presume in the 2022 test scenario that U.S. unemployment rates could rise another 5.75 percentage points to a peak of 10% over 2 years, and that the large increase in the unemployment rate would be accompanied by a 40% decline in commercial real estate prices, widening corporate bond spreads, and a collapse in asset prices, including increased market volatility. Not a forecast, just a scenario under which it's going to stress test its banks. Now, let's hear from Francis Létourneau. He's been on the road traveling in support of NuRAN Wireless, Inc. Francis Létourneau is back, CEO of NuRAN Wireless, trading on the CSE under the symbol NUR. Francis, welcome back.
Thank you very much. Yes, back from Europe. Thank you very much for hosting me now.
Yesterday, we tried to do this conversation from the airport, Charles de Gaulle in Paris, but the internet wasn't cooperating there. So, tell us, what were you doing in your travels? Why were you in Europe?
So we were there to meet with the DFIs with whom we've engaged with. Part of the announcement we did in January for the two DFIs that are coming together for a 24 million USD package, debt package for financing the infrastructure in Africa, and that was something that was planned for quite a long time. So we are now reviewing all the aspects of the company. Of course, when they send a term sheet and a mandate letter, it means that the money is committed. But you need to go through some kind of a process, and that was one of the major, I would say, milestone that we needed to reach. I think box checked. They've been pretty happy. Jim, Gael have done a fantastic job, especially Gael from an operational point of view. He's been in Africa, he knows Africa. And it was breathing through the discussion we were having with them. You also need to know that DFIs, they have a developmental focus. So you need to tick all boxes: environmental, social impact, and everything. So, and I think Gael, due to his past experience, same for Jim. Jim has been in Africa as well. They know pretty much everything about Africa. Me, I knew more on the sales side, but these guys have been rock solid during the interview.
Sure. What DFI? Who are they?
We can't disclose their names today. But it's development financial institutions. So you have a couple of those around the world without naming them. So I can drop name Asia Development Bank, African Development Bank, European Investment Bank, IFC, part of World Bank, NUR Fund, all these big guys. So two of them came out for this. We were lucky because in 2022, Gael was invited to a workshop and he has met with a lot of those gentlemen, and we were able to tap into a digital envelope that was available, but the money and everything needed to be committed in 2021, which we did and announced beginning of January. So we were lucky because typically with those large organization, it takes like 13 to 14 to 16 months to get the large senior loans. So we're in good shape with those guys, and we're now thinking of doing more. FYI, the second reason for being in Europe is we were to meet with a couple of IFIs this time, international fund, that will come as equity partner at the NuRAN African Holding level. And for the 6 million remaining, remember that the part of the 24 million, it's part of a $30 million package where NuRAN need to bring an additional 6 on top of this. We said that we're going to bring that money at the African Holding Company level. So we had 3 different meetings with 3 different groups that can cut significant checks. So it's and they're asking, do you need more? So I think we're in good shape. We can probably expect term sheet soon, and money will probably be drawn down before the DFIs themselves. But also brings me to another objective of the week, was to kick off the debt package number 2 for additional countries and to finish the build of DRC. Sorry, it takes a bit of time. And so we've started this process. We have engaged already with 2 groups in Europe that we can't disclose, of course, again, but the goal is to bring another 35 million on top of what we're doing with the 24. And this 35 million will be financing the balance of DRC, and the new countries, including South Sudan, as well as including new contracts that we foresee in the next weeks and months. So we want to get ready. So we might happen to raise more equity to be ready for that $35 million package as well. So it's a big finance play. We've talked about this several times. And the last objective, it was to meet with Orange for what we call a steering committee. So we were meeting with Orange MEA, Middle East and Africa group. The CTIO and the deputy CTIO are based in Paris, and the rest of the team is based in Casablanca. So we've met with them face to face, or mask to mask, I would say, because it's still COVID, right? So we've met with them, and they were pretty happy with the result. And I suspect that probably that steering committee, it will probably be a milestone that needed to be reached in order to get some movement from an RFP point of view, because we're still shortlisted on the 4 RFPs that we've talked about with Orange for 4 different countries. And I think that meeting, or that box tick, needed to be done sooner than later. So it was good that we could combine this in this European trip. And having Gael with me, of course, was a winning factor, because Gael has been explaining everything that we've gone through, all the different mechanisms that we've put in place to overcome different challenges that we've had. We've presented the status of the inventory, what sits at the custom clearance side, and that's about it. So they were pretty happy with the results of our thing. And FYI, we're not the only one, James, to suffer from those delays. They've told us that a lot of their projects have been delayed severely But more than that, most of the suppliers were coming back to them, say, we will increase the price because of this, and that, due to the fact that the global transportation situation is costing more than expected. So a lot of the different suppliers, OEM suppliers, were coming back to Orange to ask for more money. And they were really pleased that we didn't do. So we said, we've managed this properly. We've managed to stay in budget, so which is a good sign and a good box check for us. So that was all about the trip, and I'm extremely positive about everything that has happened there, and we look forward for something to happen and to announce in the next couple of weeks.
And so what is your anticipated cost of capital in these debt structures in terms of interest rates, and are there any sort of equity sweeteners in this whole proposition?
No. They're expecting IRRs of around 10-12%. 3.5% interest rate, 2 years capital grace, and they are looking for kickers, so dividends, to go back their way that crank up the IRR up to 10-12%. So this is the way this deal is structured. But it goes over time. So from the moment we disburse to the moment it's finished, it's like a 7-year loan period. And at the end of the day, since we're generating a lot of cash, some dividends are going back up to those DFIs.
Sure. So the structure relies on a sort of a royalty from future revenue. What is the percentage of that future revenue of the company's net profit on the net profit?
As I said, the interest is 3.5%, and to I would say IRR, projected IRR goes to 10% for one, 12% for the others, and it's dividend. So it's not like a royalty; it's generated from the cash balance that we have at the end of each period.
I see. So is it ongoing? Is it in perpetuity?
No, it finished after 7 years. So they need to reach like their 12% over a 7-year period. So it's all good, and it's already accounted into the financial model.
Okay, well that's remarkably good news. I mean, I had no idea it would be on such favorable terms, especially with 2 years grace. That's excellent in the event of some kind of economic upheaval. Okay, so right now we're sitting at 53 towers in operation, and obviously this is the money to put how many more towers online?
So the goal for these two, of course, part of the deal that we have with the DFIs, we go up to 850 in DRC and additional 120 in Cameroon. So that will make it 242 plus 850. I know, by the way, I don't have my calculator on me, but it's close to 1,100. But what we have engaged with as of today, all the equipments have been sent to Cameroon and DRC, and soon to come for South Sudan as well. We are using our own operating cash as we speak, and there's committed money for 120 sites in DRC, 120 sites in Cameroon, and all of those should be deployed within the next weeks and months. So actually this week you will probably see a press release that will outline exactly what we've presented to Orange, and that will tells you where we stand. So you have all the different bars, stock in country, custom clearance, installed. So you will have on this press release a lot of material to understand why there's been delays, where the stock stands, and so forth. So Orange is happy with the pace. We're happy with the pace as well. Of course, as soon as the sites are live, then we generate cash, because we start billing the minimum guaranteed amount, and then on top of this, the usage. So moving forward, we expect those 120 sites in each country to be delivered probably by the end of April max.
We had a question, and the question was that the NuRAN's reporting in the last quarter indicated a decrease in revenue relative to 2020 that was quite substantial, from $2 million down to just over $1 million. Is this a temporary phenomenon? Is it a one-off? Why has revenue decreased relative to the same quarter last year in 2020?
The answer to this question, James, is easy. We've made a switch from a equipment sale to a network as a service. So we've decided to go to leave the potential revenue from the CapEx sale to the sideline and focus on the NaaS contract. So that's why you see that we just stopped selling the product. We are using the product ourselves, and that's why we were not pursuing those opportunity of selling the product, hence the reason why the revenue were down. And you can expect probably the same thing over the next couple of quarters until we reach up to 450 sites delivered, which could occur in Q3, end of Q3. This is where you will see the company going back to positive EBITDA situation. But that was natural because of the business shift we've done.
Sure, that makes sense. That's a great answer. Okay, Francis, that's great. We'll leave it there for now.
Thank you. Thank you very much.
All right, so NuRAN is still bumping and grinding along here. As we covered in that segment, the revenues were down relative to the same period last year. Francis did a good job of explaining why that was as the company switches from a technology sales model to a network as a service model, and so we'll keep our eye on that. He did indicate that we would see positive EBITDA before the end of 2022, so we'll look forward to that. My next guest is Mark Beveridge. He is a principal consultant for Benchmark Mineral Intelligence. My next guest is Mark Beveridge. He's the principal consultant for Benchmark Mineral Intelligence, which, if you don't know, is the world's leading IOSCO-certified price reporting agency and market intelligence publisher for the lithium-ion battery to electric vehicle supply chain. Mark, welcome.
Thanks very much for having me.
Mark, I feel it's a auspicious day to be having this conversation. Lithium Futures is quoted on COMOX are up 5.5% on the day. And so, the remarkable price surge in lithium has now sort of imbalanced the value proposition for this whole lithium ion phosphate transformation due to the surging cost of carbonate in China. And so from where Benchmark sits, how is that going to play out in 2022 as it pertains to, the value and the price of electric vehicles going forward?
Well, it's fair enough to say, I think, that the spot price, obviously, for carbonate in China is pushing up a kind of view of LFP on a short-term basis. If you maybe compare the production cost for LFP versus maybe an NCM, which is maybe more typically produced outside of China, you would be looking at LFP at current spot prices for carbonate being slightly higher. What we probably expect to see over time is the lithium price being paid by those producers outside of China being pulled up a little bit closer to some of the spot levels that we're seeing in China currently. So essentially, some of those differences will wash out over time. We'd expect to see the lithium price push to affect the NCM cathode types, maybe produced outside of China. It would affect them in time. You'd see a bit of a recalibration of the cost there. So, really what we've seen over the last couple of years, that sort of renaissance in LFP that people have talked about, has really come about because there's been a relative improvement in performance specifications for LFP versus NCM in that time. When we look to the future, I think the bet on LFP really sort of depends on that narrowing between the specifications for NCM remaining in place. Now, that doesn't necessarily take into account all the future improvements that we're likely to see for cathode types like NCM. So, as we go forward, that rebalancing between the cost of LFP and NCM is likely to they're likely to sort of close and narrow and compete, but we don't necessarily see LFP sort of remaining either significantly structurally higher in cost or massively lower over time on a dollar per kilowatt hour basis.
On the supply side, generally, is the supply of lithium and of equal importance the associated metals that make up a battery, primarily, in this case, I'm referring to nickel and cobalt. Is the supply side keeping up with the increase in demand, or is it lagging as drastically as charts would have us believe?
Well, I mean, it certainly looks like we're going to be having a difficult time really on the lithium side for some years to come. The market looks structurally short, essentially, on the lithium side. So as a result of that, you could see unmet demand for EVs as producers simply can't find the lithium in order to produce the vehicles. I think there is the possibility of some transference of demand from maybe the energy storage side of the market, which is, it doesn't have the political mandate essentially backing it like electric vehicles does. So you could potentially have demand destruction in that sector, liberate some lithium supply, which could then flow into the electric vehicle side of the market. But yes, I mean, I think it's clear that over the last couple of years, lithium supply hasn't kept up with demand. There hasn't been that inflow of investment because of a weak pricing period, really, that has left us in this position where the market is struggling to scale up, really, to meet the demand. Now, just to sort of think about where we are with some of the other metals, maybe I'll pick nickel. Obviously, the market there is also fairly tight. Currently, given what's going on globally with the world economy, we're having problems with the supply chain. There's been a sort of cost push and inflationary pressures sort of throughout many supply chains, not just this one. But certainly looking at the nickel situation, I think we sort of see the market having the potential to keep up with demand over the next sort of 4 to 5 years. We see a higher potential for that to happen in nickel than for lithium. So with nickel, we sort of see the problem really sort of hitting later on in the 2020s. Certainly then the challenge for nickel becomes pretty stark, and we'd be looking for supply really to have to ramp up then. In the meantime, the pipeline looks a little bit better for nickel than it does for lithium.
Essentially, Mark, what I'm trying to understand on behalf of my audience is you look out across the whole lithium universe. Lithium is rising in price, supply is lagging. Cobalt is not keeping up with the supply demands implied by the increase in lithium-ion battery supplies. Nickel is, struggling and may or may not keep up in the future. So that suggests that potentially there's going to be a lot of interest across the entire electric vehicle manufacturing space, never mind the battery electric storage space, for alternatives to lithium altogether. And so do you see any, or is there any sort of alternative scenario where battery metals might incorporate something other than lithium?
Well, I mean, there's obviously a lot of speculation at the moment about sodium-ion technology. We've seen CATL, which is really quite a strong incumbent force in LFP production, in cathode active production in China, come forward and say that they'd be looking to develop their sodium-ion technology. So that in itself, I think, speaks to the fact that they see some potential there in future. I guess the issue is for me that sodium-ion, really you're looking at a technology that's unlikely really to deliver better energy density performance than LFP. The major advantage is supposedly you would be having a simpler supply chain. Obviously, there isn't a supply chain there yet for a commercial ramp-up of sodium-ion. But the theory is that obviously that is going to be an easier ask in terms of meeting demand than lithium will be. But, I think given the fact that you're looking at probably compromised energy density, the applications into EV sectors seem limited. Where I think sodium-ion has potential is probably more in the stationary storage side of things, where obviously the energy density doesn't play too badly. It's not so critical. But what is critical on energy stationary storage is low cost. And what you could be getting through a simplified supply chain and by using a sort of abundant material like sodium that also is capable of scaling again, with the caveat that would have to be sort of commercialized, and that obviously would take a bit of time. That's a real prospect, I think, for disrupting the stationary storage sector.
Have you had any exposure to the developments of the graphene aluminum-ion battery configuration being put together by Graphene Manufacturing Group?
Yeah, I mean, we've heard some interesting news about the developments on that side. I mean, again, I think a lot of these battery technologies, and there are many, they tend to come forward with certain strengths and certain weaknesses, and the graphene alumina obviously has very fast charging, fast discharging potential. There may well be applications that could be particularly useful for. I think the critical thing, though, is that has to be not only sort of developed from a pilot stage, but it has to be worked on and scaled up to a commercial level. And that really implies also working on the costs of doing that. It remains to be seen just how we would be probably cutting down the dollar per kilowatt costs involved in using a technology like that to a really competitive level. So, yes, it's. I think that the graphene aluminium ion is certainly one that would be worth watching. But these are processes that tend to take time and investment. And when you think about the road that lithium ion has travelled, that is a long-term process that's involved research and investment spanning years and many millions of dollars.
You bet. Okay, so then where do you see the biggest sensitivities in terms of the evolution of electric vehicles towards global domination of the whole mobile fleet? If it's not lithium so much because it's lagging, but it sounds like it's keeping up or might keep up, and you're saying that nickel might be more of a problem in the later 2020s. But what about cobalt? What about graphite?
So, I mean, I think the critical thing about lithium is that although we are seeing a challenge at the moment with the market looking pretty structurally short, the OEMs involved in this market are pretty much committed to that technology. So I think there's a possibility that tightness on the lithium side could limit vehicle production. We may not be able to simply make the kind of number of vehicles that would be actually are demanded by the consumer. I mean, we could be currently probably selling more electric vehicles than we can make. What we see is really that issue with lithium supply being particularly acute now. And the high prices that we're viewing also should really be a cure going forward in terms of directing capital into that market, helping projects to get finance and guaranteeing that supply is ready in a number of years' time. So, there isn't really a geological shortage of lithium per se. It's a question of scaling up that industry, directing the finance to the right projects, making a lithium chemical that meets the specifications required by electric vehicles. That is a complex and challenging process, but it is, we think, doable on the lithium side. So yes, there's sort of going to be some bumpy periods over the coming years, but I don't think that necessarily that's going to shake OEM's commitment to the investment they've made already in lithium-ion technology. When thinking about elements like nickel further out, currently we're looking at a market where benchmark's base case view is really that NCM is still going to be probably a predominant force in ex-China markets going forward. So that is going to require a huge increase in nickel supply over time. Our base case implies really you'd be looking at nickel supply more than doubling within a 15 to 20 year period, which is really quite a big ask. So I think that questions also come into play there is whether nickel can be produced in a way that meets our consumers and OEMs ESG concerns. That is really, I think, a question that sort of will be faced sort of in the late 20s with increasing acuteness, really. So there is, I think, different questions and different timings that apply to those questions coming into play.
Mm-hmm. And so cobalt and graphite?
Cobalt obviously is something that we see companies over recent years trying to thrift out of the battery. So that is a process that's ongoing. We'd be looking at cathode types, reducing their cobalt composition. That's still, even with the EVs that we're seeing coming through in future, we expect cobalt demand to increase by many times. And likewise, that is going to be, increasingly challenging as we go into the 2030s.
Mm-hmm. All right, Mark, that's a great update on the lithium space. We're going to leave it there for now. I really appreciate your time today. We'll come back to you in due course and have you back. Thank you so much.
Thanks very much.
You bet. Bye for now. As I was saying, there's a chart of Lithium Futures. It's traded on COMEX, front month, and just an incredible performance in the 1 year time frame. We're looking at it, an increase of over 251% in price and just 5% in today alone. So obviously lithium is going to be the hot commodity, as we've been saying, in 2022, and we will be covering it. We have a couple of interesting lithium strategies for you. Among them, direct lithium extraction is a technology that is not yet one of the contributors to the global supply chain in lithium, but we've been covering about 20 different companies in the direct lithium extraction space. For your information, direct lithium extraction involves not hard rock mining, where they take hard rock, crush it, grind it, and extract the lithium through a flotation process, nor is it lithium salt mining, where they basically take liquid lithium solution from volcanic tuffs, which are called salars in places like Nevada and South America, and then dry them on the surface in large salt ponds. Direct lithium extraction uses a variety of technologies, but the ones that we think are they're going to be the contenders this year are the ones that use absorbent beads and selective ion transfer, where in the engineered beads actually just selectively take out the lithium ions as they are passed, as the solution is passed across these beads. Problem with this technology is nothing has been able to demonstrate economic viability yet, though we think we've found the company that is going to do that. Full disclosure, I will be a shareholder by the time I'm telling you about it. Right now it's private. If you want to learn more, sign up on our website or send me an email, jwest@MidasLetter, and ask a question. We'll include it in the show maybe later this week. But yeah, lithium is one of the big spaces we're going to be covering. In fact, I expect with the, when you listen to the Fed and their fact that they're stress testing banks against a scenario where there's 10% unemployment, 40% reduction in real estate prices, you just got to kind of ask yourself, well, who came up with those ideas, and why are you stress testing against such an aggressively negative scenario? If those scenarios were to materialize, I would suggest that commodity prices would be among the beneficiaries of that economic meltdown, and after they all sort of had a retracement as well. But especially in the case of solid commodities, industrial commodities like lithium, copper, cobalt, nickel, and to a lesser extent some of the other commodities that could be involved, the monetary commodities, gold, silver, and to a lesser degree. Let's take a look at the gold scenario today. Gold actually made a great move last week with all of the negative performance in the market. So yeah, as you can see, gold has really started to turn around since the end of January, and is looking like this is a new trend higher that could actually retest these highs of over $2,000, $2,083 back here in August of 2020. So as we see the Fed move more towards increasing interest rates and we see the withdrawal of stimulus, you can expect that the price of gold will continue to improve. So I think that 2022 really could be a strong year for commodities. That's my show for today. Hope you enjoyed it. Don't forget to write me, jwest@MidasLetter.com. If you want to see me covering some other topics, don't forget to visit our website and sign up for our newsletter at MidasLetter.com. Thanks for watching. We'll see you tomorrow.